Ladies and gentlemen, Tevis, welcome.
I'm loving this music.
Can you hear it right now?
Yeah.
Oh, does that mean they can hear it? All right, I'm going to mute it for a sec then. Oh wait, I can just mute it like that. Okay, cool. I don't want it to be a distraction. SoFi's fireside chat should be starting within the next 3 to 4 minutes. I am listening, so don't worry. The second that it starts to play, we'll be listening in. I have also been listening to some other conversations, like for example, Marketo was live today, Block was live today. All very, very exciting. Hopefully it's the same, and hopefully it's good audio. So Marqueta's was terrible audio. Blocks was really, really good. So hopefully it's not bad. I'm banking on the fact that we can actually hear some things this time. What are you looking forward to hearing?
I'm looking forward to hearing some more details around student loans restarting in Q4, in October. Seeing if they're going to talk about that at all, or if they're seeing any trends that are forming. I think that's going to be pretty educational. I'm also going to be taking notes on the side. So,
yeah, I mean, maybe a little Wyndham Capital conversation might be nice as well. I hope it's lending focused just completely. I think that's definitely where, we will be most important to hear from. Maybe a little bit of technology platform, definitely, as that's been kind of in question over the last couple of quarters. Yeah, that's what Gene just said. Galileo progress by far will be very, very exciting to hear. And just hopefully they drop a couple nuggets that we haven't heard previously. Right now, it's not live just yet. I'll be switching over. We're listening right now, just playing probably some copyrighted music. So that's the reason why hopefully you guys aren't hearing that. But I'll turn it on the second that the voices start coming on. All I want to hear is guidance is remaining on track. Yeah, absolutely. Absolutely. It'd be quite exciting. And then obviously after this conversation, we'll have a little talk. Actually, I think it's starting up right now. So I'll keep it. I'll switch over the second it does. Yeah, it is. Okay. Bear with me.
Do it.
Okay. No voices just yet? You don't hear anything?
Nothing just yet.
Okay.
Are they actually going to have slides for this thing? I don't think so.
No, not at all.
Just a waste of all that real estate.
I don't know if this is actually refreshing it or not. If not, I'll just refresh the page.
Yeah, maybe try that.
Nope. Could just be taking a second to start up. Okay. We are actually still a minute early. It's supposed to start at 4:05. It's not even that yet. So could just be a quick transition. But yeah, they have a ton to talk about, which I'm quite excited about. SoFi's app has been down all day. Horrible app and company. So just so you know, Robinhood was also down today, and so was Fidelity. It's probably has to do something with their actual trading partners, like Apex, for example, rather than SoFi. But good commentary regardless. Still nothing. Okay. Oh, you hear that?
Yep, the shuffling.
Yeah. Okay, as long as we're live.
How you doing? Good, you? Good.
Yeah. Does not sound like we're going to get
well,
good
we'll
audio.
go ahead and get started. Welcome to the SoFi presentation
You
at
guys
the
hear that
Goldman
okay?
Sachs
Let us know in the chat.
Utopia and Technology Conference. I have the privilege of introducing Anthony Noto, CEO of SoFi since 2018. Anthony joined SoFi after serving as CFO and COO of Twitter. He was also the co-head of global TMT banking at Goldman Sachs and the CFO for the NFL. My name is Mike Ng, and I cover SoFi and FinTech here at Goldman. We have about 35 minutes for today's presentation, inclusive of Q&A. So if you have a question, please raise your hand towards the end of the session, and we'll go ahead and get a mic run over to you. First, thank you, Anthony, for making the time and coming out to be here with us today. Really appreciate it.
Thank you for having me.
Great. So since obtaining a bank charter in February of 2021, SoFi's steadily executed on its bank strategy with deposits of nearly $13 billion, leading to overall funding costs being lowered, increased lending capacity, improvements in NII, a more stable funding model. So to start things off, could you just give a little bit of background on the evolution of the SoFi platform from a student lending platform to a financial services one-stop shop that it is today, and a tech platform? In success, what does SoFi ultimately look like?
Sure. When I was talking to the board about potentially coming on as CEO, I had laid out what I thought would be a great mission and strategy for the company. And at the heart of it is I really wanted to help people get to the point that they had enough money to do what they want. Many people have been successful academically, professionally, but they couldn't really live the American dream, and how they defined it, we call that their ambitions. In order for them to get to the point that they had enough money that they wanted to be able to own the home they wanted, have the size family they wanted, live where they wanted, the career they wanted, retire when they wanted, we really had to help them in every step of their financial lives. We had to be there for all the major financial decisions they made in their lives and all the days in between. And the reason why is, if you are successful academically and professionally, and you're making above average household income of $100,000 or $200,000, it's really hard to get there. And so we have to help them avoid overpaying for what their education is relative to what they can make when they get out, avoid over buying a house in terms of it being too large relative to their income. Because they make those decisions early in their lives, then they miss investing in their 20s, and they miss 10 years of compounding. And it's really hard to catch up after having lost those 10 years. Similarly, if they actually don't make those decisions, but they're spending all of their income and they're not investing, they're making bad choices, or they run up their credit card debt. So at the end of the day, our job is to help them get their money right. That's what they should hire us to do. And for us to get their money right, we have to help them borrow better, save better, spend better, and protect better, which is basically a one-stop shop. And that's what led to the strategy of being a one-stop shop on your mobile phone. At the time, we were just desktop, just in student loan refinancing, and just in personal loans. So 2018 was really about building the mobile platform and the foundation. It was also about building out the organization to build business plans, and SoFi Money, and SoFi Invest, and SoFi Credit Card, and SoFi Relay, and then some other products that we've introduced like Lantern. And 2019 was about executing against the rollout of all those products with a general manager structure. By the end of 2019, we rolled out everything other than credit card, and we were stepping on the gas to scale. And it was really just a blitzkrieg approach to building our brand awareness and driving adoption and learning really fast. 2020 was about adding in the final products of credit card, but then also the acquisition of Galileo. And the thought process behind Galileo was really leveraging our learnings in loans. We own the technology in loans from the servers to the glass, from the metal to the glass. It allows us to innovate faster than anyone else. We're a low-cost operator. We can personalize, we can test, and it really allows us to really iterate and iterate, which drives innovation and gives us a competitive advantage. And we can drive unit economics, which also lends itself to better value in loans and better interest rates and more innovation. As we thought about that and we launched SoFi Money, which is a checking savings account in one, we really struggled partnering with FIS. They couldn't innovate as fast as we wanted to. They're expensive. And I felt like we could never really win and gain a competitive advantage on unit economics or innovation, which led to the acquisition of Galileo. We've since done the same thing in mortgages, and we have the technology and technicist to be able to provide an operating system for all of them. And so 2020 was the beginning of building out the technology strategy. So at the heart of what we're doing is we're trying to help people make all the best decisions in their lives, have great choices in between in their day-to-day products, and then leverage our technology to differentiate those products, but also to have the lowest cost and the best unit economics. And the big reason why they have to have that innovation and best unit economics is we're indifferent with what first product to use. But when you're picking that first product, we have to win. And if we do win, we'll have great economics. We don't have to rely on you taking a second or third product, which allows us to be patient and meet your needs when you have them for that second product and build trust and reliability with you. If you take a second or third product from us, our economics improve quite dramatically, and that's where we gain competitive advantage. And so here we sit in 2023, we're on track to do over $2 billion of revenue, up from less than $500 million in 2018. We'll do over $330 to $350 million of EBITDA versus losing close to $200 million in 2018 and 6.2 million members versus 500,000.
Great. That's a fantastic overview. And I, did want to talk a little bit about your member growth. In the past, you've talked about the financial services productivity loop, to outline SoFi's approach in growing the member base, but also serving existing members. For those who may not be as familiar with the financial services productivity loop, I was wondering if you could describe it a little bit, talk about what the typical SoFi member journey looks like, and what is that typical first product, second product, third product as you work on that cross-sell?
Yeah, at the heart of the financial services productivity loop is building a best-of-breed product differentiated on fast selection, content, and convenience. And we want our products to work better when you use them together. So each product on its own has to be best of breed versus competition and have the best unit economics at steady state. As I mentioned, they'll pick one product along the way, and hopefully we build that trust and reliability that will lend to a second and third product. It was hard to know when we kicked off that strategy what would be the first or second product, but we had an intuition that the most broadly appealing product with the highest utility and daily engagement would be at the top of the funnel, and the things that are less appealing or less broadly applicable at the bottom of the funnel. And that's exactly what's happened. So Relay and SoFi Money are at the top of the funnel. They're the two largest products that we have, fastest growing, both over 2.5 million today and growing quite rapidly. They have the largest contribution to cross-buy, into invest, into loans, into credit cards. About 25 to 30% of our loans are from existing members. It used to be the case about 45% of invest was from existing members. It's up to 65% now from existing members. And Money and Relay are the biggest contributors to that cross-buying. So that's the typical pattern. They'll come in through Relay, where they may check their credit score. They may connect a couple of accounts to start doing budgeting. We have data on them when they do that. We could offer them loans against their credit cards, a better direct deposit product, a better invest product. When someone signs up for SoFi Money, we're very fortunate in that 50% of our funded accounts are direct deposit accounts. They have average balances of over $20,000. A direct deposit customer does. We have their daily activities, so we know where they're spending. We know what loans they're paying, what credit cards they're paying, if they have student loans, if they're investing. And we can use that data to give them great suggestions. We try to answer for them every day. What must they do in their financial life? What should they do? And what can they do? We do that proactively through email, but also within the app where it's personalized in the member home feed. So that's the typical journey.
Great. In the past, you've talked about the ROE potential for SoFi due to the mix of businesses and the improving profitability across many of those businesses, the benefits from the financial services productivity loop, the bank license. Could you just talk about the path to get to that 20 to 30% target ROE level?
Yeah, there's two ways to look at it. One way is what does our EBITDA margin and net income margin need to be to get there? And our EBITDA margin needs to be 30%, and our net income GAAP margin needs to be 20%. The things we have between EBITDA and GAAP net income will be about 10%. And that's kind of where they are today. So one of the things when I was a research analyst like yourself, I used to do to convince our investing partners about the long-term margins of a fast-growing company was I looked at their incremental EBITDA margins. So change of EBITDA year over year divided by change in revenue. And if the incremental EBITDA margin was 30% and it was consistent over time, asymptotically, you get the 30% margin. Well, this year we've driven over a 40% incremental EBITDA margin while growing over 40% as a company. So I'm very confident our long-term margins can be 30%. In fact, some people may not realize this. Our loans have a 70% contribution profit margin, and that's steady state. I wouldn't expect it to go higher. If it did, I would reinvest to keep it at that level. Our technology platform segment is a 20% contribution profit margin that will go to 30% over time. Our consumer products margin, though, our financial services product margin, though, at CP is negative. Second quarter, we lost $4 million in contribution profit in that segment. In Q1, we had lost $24 million. And in Q4 of 2022, we lost $45 million. That improvement from 45 to 4 million was largely driven by money. In that segment, we said we'll be contribution profit positive by the end of the year. That's with us losing about $150 million in unprofitable businesses, that if they went away, our total contribution profit and EBITDA would be $150 million higher. So that incremental margin I was mentioning of 40% this year, that's with that investment in Invest and credit cards still existing. So I feel really confident in our long-term margin on an EBITDA basis. I know our equity base and where our revenue will be in the next several years. And so getting to $1 billion of net operating profit after tax is something that will take us a while to get there. But when we do, we'd be at that 30% ROE. The other way to look at it is we're already hitting a 40% ROE in our loans. Our bank has been over 20%. And our tech platform's ROE really uses very little equity at all. And so the ROE in that is well in excess of 35%. So we're on our way there, and you can approach it those two different ways.
Great. And that's a good segue into the next question, which is really about the success that you guys have been able to achieve today, right? You're a one-stop shop for financial services, and that's been operating through relatively volatile, very volatile recent times. Could you talk a little bit about the product development and your process of innovation during this period? You guys have launched 7 businesses, and in 5 years that you've been operating, you're EBITDA positive. Organic growth and tangible book value is growing. You're about a quarter away from GAAP profitability, while still growing the top line at a very rapid pace. So maybe you could just talk through the innovation process and how you're managing to profitability.
Yeah, and I think about our innovation process in 2 ways. One is the product experience, and that's its core value proposition to the consumer. And the second is its financial value prop to us as a company. When I looked at Twitter and what you saw from a lot of direct consumer technology companies and social media and otherwise is they built a big audience, and then they figure out the financial model later. Well, in the financial services industry, they're one and the same. The product by itself is financial in nature. And so when we architect it, we have to differentiate it versus other products that a consumer would care about on those factors of choice. But we also have to architect the right unit economics from day one, because if we don't, we'll just the magnitude of losses we'll have beyond customer acquisition cost and beyond building that audience and that customer base gets exacerbated on a factor of 10. And so for each one of our products, we look at the competitive set. We try to differentiate on fast selection, content, and convenience. We want to make sure that product appeals to a specific person. So I'll take Invest as an example. There's a lot of different ways to appeal to an Invest customer. Our approach was we're probably going to acquire people that are new investors or very novice investors. And so we wanted our Invest product to be simple for them to use so they could get in quickly, they could buy a stock for dollars, not in shares, and get out quickly. And so we architected that product to meet their specific needs. And then over time, the team's challenged to iterate in that product to not only continue to meet that member's needs, but the next ring of potential adopted members and the next ring. And so the product started very simple, going after novice and beginning investors, and we iterate like crazy across fast selection, content, convenience over and over and over to continue to drive adoption and broader awareness. At the same time, we're improving the monetization of that account, we're improving the variable cost of that account, and on the customer acquisition side, we're fine-tuning what segments we're going after, in what channels, with what language, with what offers. And so 6.5 years later, we're sort of experts in differentiating on the consumer side of the equation, really good at marketing at an acceptable cost and delivering a great lifetime value. But we have a core value called learn, iterate, and then that will lead to innovation. And before you know it, 6 years later, you have something that no one else has. So in Invest, we're the only place that you can buy single stocks without commissions, fractional shares, which we pioneered without commissions. We have 6 of our own ETFs, SoFi ETFs, that are specifically built for our members and their needs. We have 4 different robo accounts, many of which are award-winning, cited by Barron's. We have cryptocurrency. We have IPOs. We've done a number of IPOs. We're on the Instacart IPO, and we'll soon be launching, hopefully in early next year, alternate asset classes. We're the only place you can be a one-stop shop within Invest and get a free certified financial planner and have no fees.
I know I talked with a lot of the market constituents around the financial elements of SoFi's business. At times it almost feels like that discussion overshadows the fact that SoFi is a consumer tech company, and there's a lot of value in the brand, the tech, the app that probably doesn't get an appropriate amount of airtime in discussion. So maybe you can talk a little bit about the app and how the app plays into the SoFi consumer value proposition.
Sure. When we were developing the mobile app in 2018, I really wanted to have a reason for people to use the app beyond just sending money to a friend or checking their investments and how the stock prices are doing to buy a stock or to sell a stock. I wanted it to be more than individual products. And I thought about our job to be done, help people get their money right. I thought there's an opportunity for us to program by looking at all the data on them and all the data on other people like them to answer 3 questions for them in their financial life every day. Because if I want to help you get your money right in all the big decisions and all the days in between, shouldn't I be giving you solutions every day? And so in our member home feed, we're trying to answer 3 questions every day. And think of our member home feed like you would the home feed on Twitter or Facebook or LinkedIn. On LinkedIn, your feed is about what's going on in business that day. In Facebook, it's what's going on with your friends in that day. And on Twitter, it's what's going on in the news that day. And on SoFi, it's what's going on in your financial life. And we want to answer 3 questions every day in a personalized way. What must you do that day in your financial life? What should you do? And what can you do? And if you go into our apps and member home feed, it'll look like those other companies' feeds with cards, and those cards will be addressing those 3 questions. Now, we don't say, this is what you must do, this is what you should do, this is what you can do, but that's answering that question, implied in what we're saying. So, for example, I have a card that says your credit card is 90% utilized, and it says how much I owe, and it offers me a personal loan to term it out over 3 years at a lower rate, not 25%, but at 12%, so I could save money. Or if there's a big transaction that day, $2,500, it says there was a transaction in one of your external accounts that I happen to connect to Relay for $2,500. Were you aware of this? Or I may have gotten a person-to-person payments from a bet I had on the weekend from one of my friends playing golf, and it said you were just paid by your friend. And so that member home feed leverages all the data we have on you and everyone else. So as our member base grows, we have more data to personalize for you and help you get your money right every day. And we ultimately want people to come to the app every day, not because they need to do a transaction, but they want to see what's in that member home feed to help them get their money right.
That's great. And shifting gears a little bit, from consumer tech, but to the technology segment, could you just talk about, the role the tech platform plays in SoFi's strategy, and, how would you assess the impact and, give us a postmortem on some of the acquisitions inside tech platform, Galileo and Technisys?
Yeah, the first job of the technology platform is to help us innovate faster than we could otherwise. No one has the same approach in being a one-stop shop, all just on a mobile platform as we have. So no one really understands what technologies we need built. So having the tech platform allows us to control our own destiny, innovating faster than we could by just using other people's technology. It also gives us an opportunity to be a low-cost operator, and being a low-cost operator typically becomes a competitive advantage. So we can innovate faster, we have better unit economics. But because we're doing stuff that no one else is doing, and we're in the forefront of being the operating system for the fintech world, other people could use that technology. And we want to make it available to other people so they could serve their constituencies well. It allows the entire tech sort of platform of the industry to be elevated, and at the same time, we can make money from it. A lot of people will ask me, do you want to be an enterprise company or do you want to be a consumer company? And I want to be 100% perfectly clear. Our mission is consumer focused. It's to help our members achieve financial independence to realize their ambition. And everything we do is to serve them. For the tech platform needs to serve us well so we can serve them well. It just so happens the tech we're building is world-class and other people need it. And so we can make money off it, which improves our returns, but it will always be to serve our end mission of a company. much in the same way AWS helped serve Amazon when people couldn't build technologies for them that they needed.
Right. And no better evidence of being a consumer company, I mean, than your sponsorship of SoFi Stadium. Obviously, a very large piece of your annual marketing budget. Could you just talk a little bit about your strategic rationale there? Are you seeing the benefits from that sponsorship as you have expected to when you guys made the decision to do it? What's been the impact on member growth and other areas of the business?
Yeah, it was a very controversial decision. The controversy actually started with me. The marketing team, my first week at SoFi in 2018, I wasn't actually even an employee yet, but I was coming in the office in February 2018, and the marketing team came over. They said, "Hey, you worked at the NFL. We want to name the stadium down in LA SoFi Stadium." And I was like, "I haven't even been here like a week. Like, there's no way we're doing that. Like, those deals never work, and we can't afford it." And they came back time and time again. In 2018, we built out our strategy. In 2019, I was presenting to the board, and we were about to launch all the products. And I literally said to the board, "It's a matter of when, not if, we become a household name, when we become a top 10 financial institution." And as I was saying those, and the reason why I said when, not if, is because I knew we were ahead of everyone else in being mobile and being a one-stop shop. We're about to launch all these products that everyone had talked about launching but hadn't done. And to me, they were better than everything else. It was just a matter of becoming trusted and gaining more awareness and more market share. But when I said the word, a matter of when, not if, we become a household brand name, I literally said to myself, "Oh shit, we have to do that stadium deal." And the reason why I thought that at that moment was, they said, "What do you mean when, not if?" And I said, "It's when, not if they trust us." It's easy to give people money. They don't have to trust you. They take the money and leave. But for them to give you their money, they have to trust you. And they're not going to trust SoFi. They don't know. Only 2 out of 100 people even mention our name when they think about financial services. We need to be, someone they mention 30 out of 100 times, like JP Morgan Chase. And so unaided brand awareness is, when you think of a financial services product, name 3 companies. Well, at the time, 2 people out of 100 would mention SoFi, but 30 people out of 100 would name the top 5 banks in the country. And so I saw the stadium as an opportunity to have broad scale reach and notoriety really fast. And if you tried to buy, most people don't realize this, but we did the stadium deal for television exposure, not for game day exposure. My view was that there would be at least 4 to 6 primetime NFL football games at that stadium a year. And each primetime football game, because I used to be a media analyst and worked at the NFL, and we did the first live NFL games on social media at Twitter, I knew a live Thursday night game, Sunday night game, or Monday night game had about 20 million unique viewers. Now, the only way to reach that many people in one TV show would have been Desperate Housewives or Grey's Anatomy, like in 2002. Today, nothing's over 2 or 3 million. So I knew if we could have the game at our stadium on Thursday, Sunday, or Monday night, 4 times a year, that was at least 80 million unique viewers, or 80 million viewers 24 times. And that was much more than we were getting out of spending $20 million on 4 different sponsorships: the X Games, US Open Tennis, US Open Golf, Big East Basketball. So I thought to myself, we can move the $20 million from these inefficient things that only reach 15 million people in the entire year to reaching 20 million people at least 4 times a year. And that would help drive our unaided brand awareness. What I didn't realize at the time was that if you have a game on Monday night and it's at SoFi Stadium week 1, the same audience is coming back week 2. So in week 1, they hear the name SoFi Stadium 15 times during the broadcast. They come, but they may not know what we do. They come back the next week and we run ads at the end of the first quarter, and end of the second quarter. Then you come back the next week and we run ads at the end of first quarter and the second quarter. And the formula when I was at Twitter is, if you want someone to try a new brand, you have to hit them with the same ad 15 times. So all of a sudden the stadium tied into our media plan, which tied into hitting people, the same people that we're going after 15 or 20 times in a season every week with great frequency. I also thought it would be the most ambitious stage in the world, and the greatest acts in the world would want to play there. The World Cup would want to be there. The Olympics would want to be there. That was a little bit of a bet because Stan had to go out and win those things. And boys, he hit the cover off the ball. 6 shows of Taylor Swift, like that wasn't in the contract. The Olympics opening ceremony, that wasn't in the contract. The World Cup, that wasn't in the contract. So it was a big bet. It was one we had to make, and the team's done a phenomenal job turning it into great value for us, and it's elevated everything we do. In Q2, I mentioned that we're starting to see the compounding effects of the FSPL and the flywheel happening, and we're sitting here in Q3, and it's happening even better, and I couldn't be more excited about the growth we're seeing in members and products, and it just continue to compound on itself.
Seems like an incredibly efficient way to get a lot of impressions, beats buying ad spots on TV, I'm sure. Maybe shifting gears and talking a little bit about just the financials and guidance. Last quarter, you raised full year revenue guidance, EBITDA guidance, and also reiterated a commitment to becoming GAAP net income profitable by fourth quarter of 23. Could you just talk a little bit about how you expect the remainder of the year to play out and what you see as risks to the guidance, both to the upside and downside?
Our outlook called for an economic backdrop of unemployment going to 5% over the next year, having a relatively soft landing with flat to down GDP growth. So with that backdrop, Q3 is going pretty much as we thought it would. We were very clear that as federal student loan payments returned, that we'd see a slight uptick in Q3 and a much bigger increase in Q4. Their first payments aren't due till October 1, and they'll feather in throughout the whole month. Bills went out in September. We felt that once bills went out, we'd see an uptick in applications. We've absolutely seen that uptick in applications in line with what our guidance indicated. We also had a belief and thesis that we'd have two type of refinancing members, one of which would have a lower rate, and so they would refinance with us because they would save on rate, and that's absolutely been the case. One of which that may not have a lower rate, but they needed to lower their monthly payment, so they were going to extend the term of the loan, even if it was at a higher rate. We've seen that as well. So we feel good about our outlook for student loans, and we're excited about having that piece of the puzzle back in place. It brings people to the site. It drives other activities in addition to being a really great product and helping people solve their financial needs and getting their money right. I mentioned the compounding effect that we're seeing on member and product growth from unaided brand awareness, from being more efficient at marketing, more cross-buying. That's continued to play itself out. The tech platform, the pipeline is as robust as it's ever been from big financial institutions. We said we wouldn't see an acceleration in the fourth quarter, but if things would be relatively flat between here and there, and that's been the case, but with improving margins, and we feel great about that still. The home loans business rates are high, but we're really, really happy with what we're seeing from a operational standpoint and reliability standpoint in time to fund and home loans. But there's a clear headwind there from high rates and no refinancing marketing, just purchase marketing. But I think we're set up for great success in 24. And then on the financial services side, we talked about $2 billion of deposits each quarter and feel super confident we're on that track and continue to have a very differentiated product in driving direct deposit and more spending. And we're on that track. And it's helping us out with the Invest product. As I mentioned, 65% are cross-buying, and Invest is seeing good net flows, and we're on the Instacart IPO, which will be very nice to have as an additional benefit here in September, and wishing our partners at Instacart great success on their IPO. So we feel really good about the performance of our loans and the demand that we're seeing as well.
Great. I just want to dig into a couple elements of that, and I do want to leave some time for audience Q&A. So maybe I'll just sneak one or two more in. But just on the student loan side, could you just talk a little bit more about your expectations around a recovery, not only for this year but also into 2024 and beyond? Is there an opportunity to get back to pre-pandemic levels of refinance demand and originations? Does the kind of specter or prospect of future loan forgiveness create some sort of overhang?
No, I think we'll see the demand for student loan refinancing continue to sort of move back to where it was in 2019. It may take several quarters for that to happen. We said we'd see a small increase in Q3 and a bigger increase in Q4. We're not looking for a return in Q4 to 2019 levels. It's probably half of that or less than half of that. But there's over 40 million people that still have federal student loans, and it's a real problem for them. 200 billion of that. 200 billion of the 1.4 trillion that's outstanding is at rates higher than we currently offer in our demographic. And so that's a really big TAM at this price. at the rate that we're offering now versus what their rate is, that TAM only increases as rates go down, which they will over the course of the next couple of years. So we think it's a really good market for us to continue to build great relationships. But one thing people don't really understand is in our entire history, we've refinanced less than 1 million people's federal student loans. We have 6.2 million members, which means the bulk of our business is coming from SoFi Money, SoFi Invest, SoFi Relay, and our technology platform revenue. We're not really growing our members significantly from loans. It's a great product. It's a great lifetime value product. We make about $800 in LTV day one if it's a new member. If it's a cross-buy member that comes in through Relay at a very low CAC, or comes through Invest, or comes through Money, that profit goes from $800 to $1,600 to $2,000. So it's a great revenue generating product, great LTV product, but it's not going to drive our member base. It's going to be part of our members. We get, hundreds of thousands of new members in the other products, and we get tens of thousands of members in our loan products.
Great. And you mentioned the momentum in deposits, which has been really impressive to date. Could you just outline the strategy for ongoing deposit growth? How sustainable is it? Where are you gaining share from?
Yeah, so 90% of our deposits from direct deposit customers, and that's the key to our success. So we want to have an unmatched product so that we drive direct deposit customers. We're going to have top tier APY, no fees, best functionality, free certified financial planner. We give rewards across a lot of the activities. They can be redeemed into the money account at 2x what they would get redeemed into credit card. We just launched SoFi Travel, which is a better way to buy travel with reward points and discounts. We'll add other categories like entertainment tickets. So we're helping people use their money the way they want without paying us anything, and we're giving them maximum value. As Fed fund rates go down, non-banks that are competing with us on APY are going to have their APY go down as well. Ours may or may not. Because we're a bank, we charge an APY that helps us fund our loans at about a 200 basis point margin. We could bring the APY down when Fed funds goes down, leave our loans where they're at, expand that spread to 300 basis points, or leave it where it's at and gain massive market share because no one else can actually fund the APY where we can. We have a huge competitive advantage because we have the origination product and the deposit product. And so, a world in which rates go down, we're only going to increase our market share gains or increase our spread, which will allow us to invest more money in acquiring even more customers. And we're acquiring them at a great LTV and 12-month payback now. The share we're taking is from the top 5 banks in the country. They probably don't even know that we're taking share because they're so big and we're so small. But we see where the ACH is coming from, so we know who they are. But it's the largest banks in the country that are offering nothing in APY, and they don't have mobile products that are very good. They certainly don't have the added value that we have across our platform with free certified financial planners and the ability to do these other products at great discounts and great value. So when rates go down, I think our advantage only increases. And if they keep going up, we can continue to pass on higher rates and loans to fund the deposits, which we've been able to do. So it's a very synergistic competitive advantage that no one else can compete with.
Great. And I'll sneak one more in before I see if there are audience questions. But you talked about financial services segment being contribution profit positive by 4Q. What's the path look like to get there?
Yeah, so we only lost $4 million in contribution profit in absolute dollars in Q2. The path to get there is continue to scale money, which is very, very variable profit positive. The invest business and the credit card business I mentioned, those two businesses together are, on an annualized basis, are losing about $150 million. That will start to come down as their variable profitability improves as well, and next year even more so. And so there's a lot of leverage in the model, and this last leg is really just about scaling the profitable customers relative to the unprofitable. And when I say they're unprofitable, it's just because it's early stages in their monetization and early stages in getting all their operating costs down, just like it was in our loan products and just like it has been in SoFi Money. We've been driving over 40% incremental EBITDA margins this year despite growing over 40%. And I think you'll continue to see that happen, and that will also contribute.
Great. Any questions from the audience?
This is probably the fun part.
I'll pick up the last question. So, I just wanted to talk a little bit more about tech platform. You talked about accelerating year-over-year growth in the segment by 4Q, particularly as you start to see revenue contributions from recently onboarded customers. Could you talk about some of the cross-sell traction between Galileo and Technisys, and also talk about some of the success that you've seen in, among larger financial institutions?
Yeah, so the cross-selling or introductions that we thought would happen in LATAM. Galileo is getting a lot of introductions to Technisys partners, and that's bearing fruit for us. The area that's been surprising on the upside is, we had the Galileo platform for 2 years before we bought Technisys, and we really weren't getting into major conversations with big banks in the US. But as the big banks have started to do more RFPs for more modern technology, which has been driven by just a wave of challenges for them managing real-time assets and liabilities, we've been invited to those RFPs because of the core technology in Technisys. But as we've gotten into those discussions and been able to explain our capabilities, some of the big banks are just interested in our processing from Galileo now, or the APIs from Galileo. And those introductions wouldn't have happened before. They wouldn't have really known to reach out to us about Galileo. So that's helped us with the big banks. The combination of the both have definitely helped us with non-financial institutions that have big customer bases in non-financial categories like airlines or other areas that want to get into checking and savings in the next sort of frontier of financial products. One of the things that has not been the case with these big consumer brands is they've found ways to leverage their brands in a bunch of areas, but some have never gone into the financial segment. And they don't want to be in credit cards per se and have their customers owe them debt. They'd love to have daily engagement and opportunity to give offers, and a checking savings account branded in their name is a way to do that. So there's been a lot more interest there as well. In addition to that, it's allowed us to spawn new products. So buy now, pay later is a product that we offer on SoFi. We call it Pay in 4. That was built completely on Technisys and Galileo and SoFi full stack. And we're now offering that to Galileo's customers that may just have a debit offering. They can now offer Pay in 4 or Pay in 6 or Pay in 12. So I couldn't be happier with having made the strategic decision to buy those assets, and now seeing the benefit from it strategically has been really great.
That's great. That's an excellent way to cap off the session. Anthony, it's been such a privilege to be able to host you here. Thank you so much for your support and participation.
Appreciate it.
Woo! That one was hot. I was enjoying that a lot. Holy. Okay. Did you want to do a recap now, or would you like to join me on the FinTech Frenzy later on? What do you want to do, Tevis?
I can't do later on, so let's just do it now.
Okay.
I can do like another 15 minutes now, and we can do, or maybe 30, and we can do a recap. Does that sound good?
Yeah, I could probably do 15. I can do till 5 for sure. What'd you think?
Yeah, I mean, a lot of things that we already knew.
Yeah.
But definitely a couple of interesting, even if it is just a reframing on something that we've already known, really interesting to see how he's thinking about that scale going forward, especially in the beginning when he broke out all of the years. It made sense from this linear perspective. 2018, building mobile platforms, building the organizational structure. 2019, scaling that. And then 2020, you're adding some more products. You're adding credit card, you're adding Galileo through the acquisition, and then scaling that, so on and so forth, to improve their financial services productivity loop, which it seems as though it's improving. A couple of the things that I found interesting, obviously the SoFi Stadium stuff being around the television appearances. It just seemed like a good ROI in terms of eyeballs to money spent. And then you have all of these other events, because the stadium is actually an amazing location, amazing venue, right? And it's one of the biggest stadiums in the US, so you can host huge events at it as well. So in addition to the television appearances, there's so much more in terms of the Super Bowl, like this Taylor Swift concert, like the World Cup, the Olympics.
That got me so hyped up whenever he was going over the list of things that he goes, we didn't anticipate this, we didn't anticipate the Olympics, we didn't anticipate Taylor Swift or any of these artists. I got so enthusiastic whenever he's talking about that, because honestly, I think early days, the stadium was kind of a big contentious moment, especially whenever people were like comparing it to like FTX Stadium and stuff like this. Obviously, I think now it's been cemented that this was an absolute stunning deal, especially whenever it comes to advertising costs. If you were to look at the impressions versus what we're paying on sales and marketing, this is probably bringing down our average sales and marketing costs greatly. greatly comparatively to maybe what we would be paying to bring on clients previously. I mean, nuts.
And then the other piece that I found interesting is the payback period. I always thought it was 24 months, but he said 12-month payback period. I'm not sure if that's changed from our previous, or maybe that's just newer cohorts. He's seeing that, but 12-month payback period is pretty amazing.
I didn't even hear that. See, this is why I like transcripts mainly, and I don't listen to the calls because I find I miss much more than just reading it. But if he did say a 12-month payback period for customers, I mean, yeah, that's much shorter. Usually, I think we brought it down to 14 months was what I saw in Q2, something around those lines.
So if they're consistently bringing down that payback period, they're seeing the ROI from users, like from cohorts of users sooner, which obviously helps them scale faster.
Yeah. I wanted to bring up some of the things that he said. He said Q3 is going as expected. I wanted to bring up their earnings presentation to see what they guided for next quarter, because obviously that's what they're saying. They're looking towards it once again. Where is it? I have full year. Oh, actually, you know what? They don't break it down into next quarter. They do second half. So yeah, we're not going to get a clear picture that way. But okay, yeah, they said student loans are seeing a slight uptick. That's what we had both anticipated for Q2. Happy to see that they're seeing that in Q3. They're saying that in both ways that we saw that we would get new clients, both on the lower rate side or people that are extending their terms, keeping a high rate of interest. They're seeing both of those bring on new clients. They said it may take several quarters to get back to 2019 levels. Going forward, we might only see half of that for now.
Yeah, and I think
that's a little rough.
Yeah, and that's something that we have been talking about. Well, I mean, Chris made that article saying that in originations for student loans might be lower. And then I've been releasing last week a couple of videos around this like on-ramp period that was introduced that basically removes all the negative consequences around delinquency. And so it might take a couple of quarters to see it. And it might also affect the numbers of like the repayment rate of student loans as well. So like it's a different landscape, right? And we have to treat it as a different landscape. It's not like they can just flip a switch and it's back to, the peak volume that they were doing before this thing was turned off, right? So it's like you're introducing it for the second time, like a new product, right? One of the things that I found interesting is that, and I'm probably going to tweet this out later, he was saying when rates go down, I think our advantage only increases because basically of that synergistic advantages of them having origination products, them having deposit products, and like how those things work together to make it so that other people can't compete in terms of that APY. And I think that's a really powerful statement because right now everybody is really conflating the Fed raising rates with SoFi having high APYs. And they're like, well, everybody has high APYs. But the fact that SoFi has the bank charter and the fact that they have like a tech platform with Galileo as well, and how all of these things play together, like they don't need to rely on like warehouse lines of credit or other funding options. Even if rates go down, everybody's rates are going to go down from an APY perspective, but SoFi's are going to go down less, relatively speaking, because there's more juice to squeeze there.
Well, I think especially like whenever you're talking about competitors like Robinhood that don't have that bank charter and play it so close to the chest, like the rates are so high right now. Yes, they have some cushioning with the money that they're actually making from their gold member payments, which I think is $5 a month or something like this. They will obviously drop rates very quickly to that announcement, right? SoFi will be able to hold. They did say, however, though, that they think market share will increase as rates go down. But although bringing up non-banks, didn't really even say like they're even planning on taking market share from them. They said all the growth is coming from the top five banks right now. And they're so big, they might not even know that people are leaving.
Yeah.
Obviously they do, but that just shows you how big the total addressable market is and how many people we can take over time.
Yeah, and the other interesting piece with regards to taking market share from the top 5 banks is the B2B aspect as well. With the last piece that he said there, between the synergies between Galileo and Technisys, like everybody thought it would be the other way around, right? Oh, well, they're going to buy Technisys, and that's a great opportunity to introduce Galileo into LATAM. But what we're finding is that Technisys plus Galileo creates a very unique value proposition for the largest financial institutions in the US.
Yeah.
And that's where the big money is, right? Like you would want to be replacing some of these legacy systems of US financial institutions as opposed to trying to break into new locales. And I think that's an even better combination of those two.
So yeah, we're definitely like, I've gotten to a point with SoFi's technology platform where I'm kind of at the point where I'm like, I'll believe it when I see it. You can say it's the best. You could say you're very like, I am very excited that he said big banks have surprised us the most with their interest, allowing us in on their RFPs, requests for proposals, right? So if they're allowing a bunch of companies to pitch them, they're allowing Galileo and Technisys at those tables and to show off their product, which will lead hopefully to larger percentage of deals. But that being said, we still just need to see something. They are saying, as far as I know, Q4 will be the big turning point for Galileo. That's when the growth is expected to ramp up, and we should see revenues from deals that have closed previously. But let's see it.
Yeah, and look, they've been giving us the playbook this entire time by saying we're going to have longer lead times, we're going to have sort of more red tape, but we're going to have fewer turnovers in terms of the clients that we do win, and they're going to bring with them many more accounts in terms of millions that they migrate over. And 2023, 2024 even are going to be pilot programs, but once they are validated, then you're going to see a really fast ramp.
Well, honestly, I think the pilot programs are probably live right now. Like
right, exactly.
That's what at least I'm hoping, is that a lot of these deals have already closed, because like we have been in those sales cycles. But hopefully they start turning into real deals, hopefully come 2024. What I didn't necessarily think was, and he's saying that I'm not understanding it, and hopefully I'm not. But he said, what I think a lot of people don't quite understand is that we have only ever refinanced 1 million student loans ever. Today, we have 6.2 million members, and there's a ton of new cross-buying opportunities. I don't believe that for crap. Like, I don't think that a member that comes onto SoFi Invest is instantly a opportunity for student loans. But then again, he did literally say, I don't think people understand how well this is going to go over. And I don't. So please, I hope I'm proven wrong.
A couple of points. So with regards to Robert's comment, they did mention SMB simply by saying that...
this one?
No, other one? And he mentioned... he basically said that their buy now, pay later product is extended onto the Galileo side, and they can modify their payment terms by 4 payments, 6 payments, or 12 payments. That's that SMB lending that we were talking about last week, which is basically offering these businesses. And he actually mentioned airlines as a sort of case study. He said this is really popular with non-financial institutions, that they don't have these mechanisms, and they don't necessarily want to break into credit cards per se, but they want to be offering promotions and rewards and stuff to their people. And so it's perfectly synergistic, because Galileo can have all of that infrastructure out of the box for these non-financial institutions on the B2B side. So that's to the extent that I heard around the SMB lending in general. Anything to add on that? Because I'll pivot.
No, I mean, I think Marqeta said the same thing. I think SoFi's Galileo will see the same thing. The next massive place now will be embedded finance. These are non-financial institutions that want financial-based products, right? Mm-hmm. Probably the greatest example of an embedded finance solution for a non-finance company is Starbucks. Okay, they had their loyalty program, which might be the most successful out of any company that I've ever looked at, and that has led to an entirely new base of revenue for that company. If SoFi can then say, hey, by the way, they do offer loyalty programs and all these other things, integrate these into your already existing business, there is a massive, massive opportunity for that. And it's supposed to do something like, I don't want to misspeak, but it's something like 10x or something over the next 10 years. Like, it's a ridiculous, ridiculous opportunity as embedded finance.
Yeah. And so I guess time will tell. I mean, they said that the margins are going to come back on the tech platform as early as Q4. So that's something to look forward to. I think one other interesting piece that I sort of jotted down, and I want to get your take on this, on the FSPL, the Financial Services Productivity Loop. Basically, they're cross-selling entire moat, which is a big reason why I'm in SoFi.
Yep.
The host asked around, what does that funnel look like? Like, what's top funnel, what's bottom funnel? And Noto responded that highest utility products are at the top of the funnel and less appealing stuff at the bottom. So like Relay and SoFi Money are at the top, and then they have the largest contribution of cross-buy into the loan segment. And it makes sense, right? Because you have lower barriers to entry to have a Relay versus like a mortgage. And so as a result of that, Relay and SoFi Money are the fastest growing segments in SoFi, and lending is slower growing. One thing that he mentioned was that they used to have 45% of invest from existing members, and now it's 65% from existing members.
Wow.
So, but I'm not sure, like, that speaks to more cross-buying.
Yeah.
Is that how we should be thinking about it?
What do you mean?
Well, so
what else are you thinking? That people are coming directly to the SoFi Invest platform? What else could it be other than cross-buying?
Concentration risk?
Wait, no, I'm not worried about that. What if they said, hey, we have an opportunity to make SoFi invest for 100% of members, or for 30% of members, you're going to choose 30 because there's concentration risk?
No, it'd be the other way around, right?
What are you saying? I want them to cross-sell into SoFi Invest. What's the problem there?
So, okay, is that how you understood it, where they had previously 45?
I didn't even hear this part. So this is why I need the transcript. I missed this part.
Yeah. So, and I think I need to go read it again because he sort of skimmed that. But I think the way, like the bullish way to read it, is that they had 45% cross-selling before, and now they have 65% cross-selling. And that would be definitely bullish, because that just means that people are liking the ecosystem more.
Sure. Yeah. What's the negative part, Tevis?
No, I just wanted to confirm that that's also like how you heard it. But yeah, I think like once we see the transcript, it's going to be a little bit like, because I just have half written notes here that I've been like scrambling to write.
I do find, however, that Seeking Alpha does post the fastest transcripts. They're usually out in about an hour and a half, so we will have them before the FinTech Frenzy. But yeah, I mean, hey, if anyone wants Seeking Alpha subscription, I've got a link down in my description down below.
The last sort of interesting piece that I found that I jotted down was just how the commentator, the host, framed it. Like, they've launched 7 businesses in 5 years, all the while 4xing their revenue in 5 years. From under 500 million to now doing 2 billion. And how Anthony Noto responded to that was basically, in one sentence, unit economics is important. If you launch if you launch all of these businesses as sort of standalones that they can stand on their own 2 feet without siphoning funds from other streams, then that's a sustainable way to do it. And if it takes a little while for them to grow or whatnot, or like to pick up steam and become positively contributing to the flywheel, then so be it. It doesn't really matter that much, because as a standalone, it is profitable. And I guess that's really the main thing that we're looking at right now for financial services, because it's the only thing that's not profitable.
Right. Yeah, there was a couple small nuggets in there that were exciting. Average direct deposit member holds $20K in their SoFi Money accounts. Alternative asset investing is coming to SoFi Invest approximately next year. SoFi right now is focused heavily on the health of their user. They always talk about this, repeated constantly. But I do think that that's why you're seeing so much focus on products like Relay and why there's so much success there. Because I do think that they know if they can actually really give a great benefit to their user in the long term, that will help going forward for sure. But yeah, and by far, it's crazy that there are some products like SoFi Invest and SoFi credit cards that are such major losers for SoFi right now. And SoFi Money is just carrying the team on its back right now. And you're seeing that across the board for fintechs, like Robinhood's seeing a very similar thing. Like their money accounts are just making so much net interest. But still, very interesting to hear that. And as things sort of get better across all the different products, that we will absolutely see contribution profit across every single segment for SoFi. I could not, I really want to just state this again, Tevis, that this is by far the number one fintech that I have my sights on. There's so much opportunity for them. There's so much growth and management, as you can hear, like from Anthony Noto's perspective. He was saying I a lot. I don't know if you also picked up on that. He was like, this is why I wanted the stadium. This is why I developed the app this way. This is what it was like. The team was out of it on this call. It was all, he developed the app this way. He bought that deal. He did everything. But I do love the management team. Anthony Noto's an absolute killer. Any last things to say, by the way?
No, nothing on my end other than that. I think it was like a 35-minute talk and we just did like a 25-minute recap. So,
cool. Yeah, it's exciting what's next for SoFi, but Q3 should be interesting. Q4 should be a slam dunk. That's really what I keep getting out of this. And maybe it's a continuous goalpost pushing for SoFi investors, but things are getting better, right? We're still triple beating every quarter. Yeah.
And I think we're going to be able to refine more once we actually see the transcript. And if there is something that really sticks out that we might have missed other than what we've already mentioned, then we can definitely talk about that. Probably later tonight on your show or
yeah, I'll definitely be talking about it on the FinTech Frenzy show out at 8:30 every day. All right. Thanks, everyone. Tevis, you're the freaking man. I'll talk with you guys later.
Thanks, y'all. Bye.
Bye now.